Tesla below $430 is not a trend breakdown. This move is a late-stage correction inside a long-term uptrend. And in today's video, I'll walk you through exactly why, using only chart facts, not fear, not headlines. Good morning, everyone. Ken here. If you're a long-term Tesla investor, this video is designed to give you clarity. You'll understand what phase Tesla stock is in right now, what the market is actually signaling beneath the noise, and how to think about positioning calmly and rationally. Let me start with the big picture. Despite the recent drop, Tesla's long-term structure remains intact. This is not a collapse. This is not the start of a bear market. What we are seeing is a digestion phase after a powerful rally. That distinction matters because reacting emotionally to a correction is how investors lose money. Understanding structure is how investors survive and grow. The first place we always begin is the weekly chart. On the weekly time frame, Tesla is still trading well above its 200-day moving average. This line represents the average cost basis of long-term participants. When price is above it, the long-term trend is considered healthy. Right now, Tesla is comfortably above that zone. That alone tells us something very important. Long-term buyers are still in control of the bigger structure. Short-term volatility does not change that. Now let's talk about why this drop happened in the first place. Tesla recently surged into the $480 to near $500 area. Moves like that attract momentum traders, leverage, and short-term speculation. Whenever that happens, a reset becomes mathematically inevitable. Early buyers take profits, late buyers exit, leverage gets unwound. That process feels ugly, but it is normal. It does not mean the story is broken. It means the market is rebalancing. When we shift down to the daily chart, we start to see this more clearly. Tesla is currently trading below its 20-day moving average. That tells us the short-term trend is weak, but at the same time, Tesla is still far above its 200-day moving average. This creates a very specific condition: short-term weakness inside long-term strength. This is exactly what a correction inside an uptrend looks like. Not a breakdown, not a trend reversal, a pause. And this leads us to an important concept: the difference between a correction and a collapse. A collapse happens when price loses long-term moving averages, fails to bounce, and continues making lower lows with increasing selling pressure. Tesla is not doing that. Tesla is pulling back, stabilizing, and compressing. That difference is everything. Momentum indicators confirm this picture. On the daily chart, RSI is around the low 40s. On the 4-hour chart, RSI is in the high 30s. These are not overbought levels. They are not euphoric levels. They are approaching exhaustion zones. This tells us selling pressure is already well developed. In other words, most of the easy downside has likely already happened. That does not guarantee an immediate bounce, but it does reduce the probability of a straight line crash. Next, we look at volume. During major market panics, volume explodes. You see huge red candles with massive participation. We are not seeing that. Daily volume during this pullback has remained relatively controlled. That means this is not mass capitulation. It is rotation. It is positioning adjustment. Big money is not fleeing Tesla. Volume delta gives us additional insight. Yes, we see negative bars. Selling is present. But we do not see persistent stacked negative pressure. That tells us the selling is mostly coming from short-term traders and momentum participants, not from long-term institutions dumping positions. This again supports the correction narrative. Now let's talk about the price map. There are three levels that matter most. First is the $400 zone. This area has already acted as support multiple times. If Tesla holds above 400 on a daily closing basis, the correction remains healthy. Second is $430. This aligns closely with the 20-day moving average. If price reclaims 430, short-term momentum starts to improve. Third is the $445 to $450 zone. That is where the 50-day moving average sits. A break above this area would signal that Tesla is likely transitioning back into its next upward leg. These levels are not predictions. They are decision points. So what should investors be doing right now? Not aggressively buying, not panic selling. This is a preparation phase, a phase of patience. Professional investors wait for confirmation. They do not chase red candles. They do not chase green candles. They wait for structure. From here, there are two realistic scenarios. Scenario A, Tesla holds above 400, reclaims 430, and gradually pushes toward 450. That would suggest the correction is ending and a new advance is beginning. Scenario B, Tesla briefly dips below 400 and tests the high 380s near the 200-day moving average. That would be a deeper correction, but still a correction, not a long-term breakdown. In both scenarios, Tesla remains inside its broader uptrend. This is where long-term perspective becomes critical. Tesla is not just a car company. Tesla is an AI, robotics, energy, and autonomy platform. Short-term price swings do not change that trajectory. Markets move in cycles, trends move in waves. Corrections are the cost of admission for long-term upside. My forward-looking view is simple. As long as Tesla continues executing on autonomy, Optimus, energy storage, and AI infrastructure, the long-term valuation ceiling remains far higher than today. The market is currently digesting gains, not rejecting Tesla's future. So let me leave you with this. Tesla is not breaking. Tesla is digesting. Stay calm, stay patient, respect the structure. That is how long-term investors win. If you found this analysis helpful, please hit the like button. Subscribe for daily Tesla-focused market insight. Thank you for spending part of your day with me. Let's continue enjoying the Tesla future together.